It's not for some reason. It's odd. Any suggestions here, Melissa?
It did come up on the screen. Are you not able to advance it?
I just can't see it. So right now, are you seeing it? Are you seeing the presentation?
Yes.
It's odd. Is there something I need to press so that I can see it?
Okay, I'm asking for assistance right now.
Here, now, can you guys see it now?
Yes.
And let me just test one thing, and if this works, we'll be good to go. It's not letting me. Here we go. Did you see this slide advance just now?
Yes.
Okay, good. Then we're good to go. All right.
Okay, very good.
Okay. So it's our presentation today, in nonprofit and antitrust law. And here's our agenda for today. I'm gonna talk about just went away again. That's odd. Something's going on, but hopefully it won't. It jumped away from me. This is the agenda, what we're going to talk about today. Nonprofit law basics, focused on both nonprofit corporate law and federal tax exemption law. Then we're going to jump into the antitrust side, talking about some antitrust basics, talking about how the antitrust laws apply to associations like yours, talk a little bit about antitrust compliance programs, and then leave it open for Q&A at the end. But like I said, please ask questions throughout. So, very frustrating.
Okay, Dana, are you on now?
I'm here.
Can you give him any assistance? He's
Yeah,
struggling.
Dana, it keeps my screen. When I go to the slideshow and I'm sharing it, I'm looking at it. And Jeff Fagan?
Yes, sir.
Yeah, you have the presentation because I emailed it to you.
I do.
Yeah, maybe if you can send it to Dana, that would be great.
Yeah, I'll send it to her, see if she can get it fired up.
All right, let me try to power through this and see what happens. Okay, so there is, as the slide says here, there's a notable difference between a nonprofit organization's nonprofit corporate status and its federal tax exempt status. So once you form as a nonprofit corporation by incorporating in any state or DC, that just makes you a nonprofit corporation. It does not automatically make you federally tax exempt. Just lost it again. It does not automatically make you tax exempt. You have to go to the IRS to apply to the IRS to get them to recognize your tax exempt status. So if you just formed as a nonprofit corporation and you did nothing else, you would actually be a taxable nonprofit corporation. Despite the name, nonprofits, this thing keeps jumping back and forth. Despite the name, nonprofits are not limited in the profits they can earn. It's just that nonprofits have no owners or shareholders, and all the profits have to be reinvested back into the corporation in furtherance of its nonprofit mission and purposes. To form as a nonprofit corporation, you organize under the laws of one of the 50 states or DC. Most of these laws are based on the American Bar Association's Model Nonprofit Corporation Act. Just for your reference, NECA is incorporated as a DC nonprofit corporation. And it's not uncommon to be incorporated in one state, but to be headquartered or located in a different state. That's very common and appropriate, and there's a mechanism for doing so. State nonprofit corporation statutes, like the DC nonprofit corporation statute, regulate a wide array of governance, operations, and activities of nonprofit corporations, and they also contain, what we call default provisions, that if certain things are not addressed in your articles of incorporation or bylaws, the statute provides for certain default provisions. A nonprofit's internal governance rules, like its bylaws and its policies, must be consistent with the nonprofit corporation statute of the state of incorporation. And the hierarchy goes the state nonprofit corporation statute, the articles of incorporation, the bylaws, and the policy. So each one has to be consistent with what's above it. And if that's not the case, then whatever below it, which is inconsistent with something that's above, would be null and void. Now, federal tax exempt status. So the vast majority of all nonprofit corporations in the U.S. are exempt from federal corporate income tax under Section 501c3 of the Internal Revenue Code. This tax exempt status, this category provides numerous benefits, but also imposes a number of limitations and prohibitions. Other nonprofits are recognized as exempt from federal corporate income tax under other sections of the code. For instance, NECA is tax exempt under Section 501c6, while Electri International Foundation for Electrical Construction is tax exempt under Section 501c3. And it's not uncommon to have one nonprofit corporation tax exempt that's affiliated with and often controls a separate legal entity under a different tax category, like NECA has, and like many of you might have in your organizations. Federal tax exempt status is generally recognized through the filing of an application with the IRS. To get that exempt status recognized, it's a Form 1023 for C3 organizations and a 1024 for most other categories of tax exemption. In terms of annual filings, tax exempt entities have to file some form of the IRS Form 990 each year. There's 3 different versions depending on the size of the organization: the regular 990, the 990EZ, and the 990N, as well as the 990PF for private foundations. And then you're required to file the IRS Form 990T and make quarterly estimated tax payments if you earn any unrelated business income, which I'll talk about in a minute. Recognition of federal tax exempt status can generally be utilized to confer a virtually automatic exemption from state corporate income tax. And there it's based on the state in which your principal office is located, not the state of incorporation. Some more on federal tax exempt status. The private inurement doctrine, which is something you should be aware of, is applicable to most categories of tax exempt organizations, including C6s, while the private benefit doctrine is generally only available to C3s. The private inurement doctrine prohibits paying excessive compensation, which means greater than fair market value compensation, to those with an ability to exercise substantial influence over the organization, such as officers, directors, and key employees. All tax exempt entities can potentially lose their exempt status for private inurement, but only C3s and C4s are subject to what are called intermediate sanctions, which are basically a series of penalty taxes, excise taxes, that the IRS can impose both on the recipients of excessive compensation as well as those who approved it. There's something called the rebuttable presumption of reasonableness, which can significantly help to protect against IRS findings of private inurement and the imposition of intermediate sanctions, and should be a best practice for all tax exempt organizations, including yours. There's 3 steps to this rebuttable presumption, and even the IRS Form 990 asks each year, are you setting executive compensation based on these practices? One is that compensation should be set in reliance on appropriate comparability data. That means looking at things like appropriate salary surveys, compensation studies, bringing in a compensation consultant sometimes, particularly if you think you're pushing the envelope on executive compensation, looking at the Form 990s of similarly situated organizations. For you guys in a situation like yours where you have chapters and whatnot, it's helpful in that there's a very good kind of pool of peer organizations to look at. All of you can look at each other's organizations. All of this data is publicly reported on the Form 990. So you have a great pool of kind of comparable organizations to look at to try to determine what is fair market value. That's the purpose of relying on appropriate comparability data. Second, the compensation decision should be made by independent decision makers. So for instance, if you're the executive director, your compensation should be set, by your executive committee or your board or whatever, or a compensation committee, whatever the structure is. But you should not be making that decision. That you need to recuse yourself from that and let those independent decision makers make those decisions, relying on that comparability data, and then the process should be contemporaneously documented. And finally, the private benefit doctrine, again, which only applies to, say, your related foundations. It's basically a balancing test between public benefit and private benefit of various activities. meaning that the public benefit has to outweigh the private benefit, and the private benefit cannot be any greater than necessary in order to achieve the public benefits. Exemption from federal corporate income tax does not automatically confer exemption from other forms of federal, state, and local taxes, such as unrelated business income tax, federal payroll tax, state and local sales and use taxes, and property taxes. In most states, cities, and counties, the C3 exempt status is a prerequisite to state sales and use and property tax exemption, but there are usually other requirements as well. Now, tax-exempt organizations are permitted to have both taxable and tax-exempt subsidiaries and affiliates, both those that are recognized as separate legal entities for federal tax purposes, such as both tax-exempt affiliates like your related foundations, as well as taxable for-profit subsidiaries. And then in recent years, the use of single-member LLCs, limited liability companies, which are disregarded for federal income tax purposes. They're basically part and parcel of the tax-exempt organization, but they provide a great degree of liability protection for risky activities. Those have become increasingly common. Subsidiaries and affiliates are used for a variety of purposes, such as being able to engage in activities that are prohibited or limited by the parent's exempt status, liability protection, funding opportunities, government grant and contract indirect cost rates, public charity status, joint ventures, to enable multiple owners and facilitate investment and sale down the road, say of a for-profit subsidiary, public reception, having separate Form 990s, and having separate governance structures. These are all some of the reasons why associations utilize subsidiaries and affiliates. We were doing so well, and it just bounced back. There are limitations and prohibitions on the ability to transfer funds and resources between and among certain tax categories of parent subsidiaries and affiliates. And common examples of subsidiaries and controlled affiliates include related advocacy arms, like the C3 having a related C4 is very common, related foundations, taxable subsidiaries, chapters, obviously, and single and multi-member LLCs. All right, next slide. So 501c6 tax exemption, let's drill down a little bit more. These are some of the hallmarks. The exempt purposes generally have to be for associations and other C6s to promote, further, and advance the industry or profession that's represented by the organization. In your case, it's the electrical contracting profession / industry. Most C6s are either membership associations or chambers of commerce. As I said, it provides an exemption from paying federal and state corporate income tax on your net income. Contributions to C6s are not tax deductible as charitable contributions, but they usually will be deductible as business expenses, being able to take a business tax deduction. So your members that pay, for instance, membership dues and conference registration fees and even sponsorships and advertising and things like that, they are generally able to take a full business tax deduction for those payments. I already talked about the prohibition on private inurement, which is not paying greater than fair market value compensation to insiders. There is a limitation. This is never really going to be an issue for you guys, but political campaign activities cannot constitute more than half of the organization's overall activities. Political campaign activities are supporting or opposing candidates for public office. Things like making political action committee contributions and running ads to support candidates or oppose candidates for office. And that can't be more than half of your activities, but that's completely separate and distinct from lobbying. Lobbying, where you're trying to support or oppose pending or proposed legislation, for instance. You can engage in as much lobbying as you want, as long as it's related to your mission and purposes. There is, I forget if I have something on this, there is something called the lobbying tax law. I think it's on the next slide, which relates to it affects the tax deductibility of membership dues paid to associations that lobby. And then finally, the taxation of unrelated business income. You can earn it. You can earn unrelated business income, but it cannot be more than insubstantial. There is no hard and fast definition of what that means, but most experts put that at around 50. Your total gross unrelated business income should generally not exceed more than 15 to 20% of your total gross income. If it does, then you risk putting your tax exempt status at risk. The most common form, the way it works is it's the net income. So after you offset it with directly connected expenses, and whatever net income is left is subject to the 21% federal corporate income tax rate. And then whatever state you're located in, if there is a state corporate income tax, like most states have, it's subject to that corporate income tax as well at the state level. The most common form of unrelated business income is advertising income. And then there are numerous exceptions to unrelated business income for things like royalties, corporate sponsorships, trade show and convention income, in most investment income, most capital gains. I've done entire presentations on unrelated business income issues, which are kind of beyond the scope of this presentation. I do, by the way, on our firm's website, and you'll see the website address on the last slide, we have a ton of articles on all different association legal and tax issues, including a lot of articles on things like royalties and corporate sponsorships and UBIT and things like that. So if you're interested in in reading more or learning more about any of those, either shoot me an email or just look on our website. We also have a lot of recorded webinars on these topics as well. Yeah, so I didn't get into the lobbying tax law in the 501c6 area, but basically it's a law. It's been around since 1993, and what it requires you to do, it's only for C6 organizations. It requires you to track your lobbying expenses, and then at the beginning of each year, you kind of do it on a prospective basis. You do an estimate. You divide your lobbying expenses by your total membership dues and similar income, and that resulting percentage is the percentage by which your membership dues and similar income are non-deductible as a business expense to your members that are paying those membership dues. And you're probably, if you engage in any lobbying, you're probably well used to the mechanism that you go through each year to report to your members the amount of their membership dues that are non-deductible as a business expense because of your lobbying. And then you report that in the Form 990 as well. 501c3 tax exempt status. I'm not going to spend much time on this, but again, relates to your related foundations. It's an exemption also from federal and state corporate income tax. Contributions to C3 generally are deductible by donors as charitable contributions, less the value of benefits received in return. And there are numerous other benefits to the C3 status as well, as you can see here. Same prohibition on private inurement. There is this prohibition on impermissible private benefit. There is a limitation on lobbying. C3s can engage in lobbying, which is supporting or opposing legislation, but it cannot be substantial. No real definition as to what that means, but if you're a C3 and you lobby, you can make what's called a 501H election, and then you actually have numeric limits on basically up to about 20% of your budget can be spent on lobbying. Complete ban on political campaign activities, supporting or opposing candidates for public office. C3s cannot do that at all. Same rules regarding unrelated business income. And then finally, a lot of associations use their related foundations to try to take advantage of state and local sales and use tax and property tax exemptions. If you want, the rules regarding particularly sales and use tax exemption and property tax exemption vary state by state, city by city, county by county. The C3 status is usually a prerequisite to exemption, but it's not the only thing. But if you are able to secure, for instance, an exemption from paying sales and use tax, and for instance, if you're holding meetings or events and you're paying for food and beverage, if you can structure it in a way where you can run the event through your foundation, you can often avoid paying any sales tax, for instance, on the food and beverage that you purchase. It's a bit more complicated in going that route, but something you should be aware of. All right, now we're going to move on to antitrust law. But before I do, any questions on anything that I've talked about so far on kind of the nonprofit, corporate, and tax side? All right, I can't see you guys, but hearing none, I will move on. But if something comes to mind, feel free to ask at any time. So, second part of our presentation, and the more robust portion of it, antitrust law. A few basics. First off, the antitrust laws are designed to kind of promote and ensure free and fair competition. That's the basic purpose. It's not designed to protect competitors, but it's designed to promote, fulsome competition, believing that if there's fulsome competition in the economy, it's going to be better for consumers. It's going to drive down prices. provide more options in terms of products and services, etc. Most countries use the term competition law. We use in the U.S. antitrust law. The basic idea is that antitrust laws, there's a variety of laws which I'll talk about. They have different nuances to them, but the basic idea is to prevent companies or groups of companies from obtaining the power to control a market through means other than competition on the merits. Generally, it's not a violation to exercise that power that you might have, and there's nothing wrong with winning by innovating or running a better business. But as you'll see, there are a number of limitations and prohibitions that stem from the antitrust laws. There are different categories of antitrust laws. The first category here are what a lot of folks call kind of the horizontal provisions of the antitrust laws. They relate to agreements between competitors and other coordinated and multilateral conduct, meaning they're called horizontal because if you think of like electrical contractors, for instance, they competing against each other. Not every contractor competes against each other, but say the contractors in a given city, if they compete against each other, they're all horizontal competitors. And these types of antitrust laws in this first category, which is what we're going to focus on, because they're really primarily the only category that applies to associations. They require some sort of coordinated conduct or agreement between competitors, two or more competitors, in order for there to be a violation. Whereas, as you'll see here, like the monopolization, like Section 2 of the Sherman Antitrust Act, that type of violation can occur from a single company. So the horizontal violations require agreements between two or more competitors. The Section 1 of the Sherman Antitrust Act, the federal law, which has been around for over 100 years, and then the Section 5 of the Federal Trade Commission Act. And then every state has their own antitrust laws, which are very similar to and kind of modeled after the federal antitrust laws. Monopolization is regulated by Section 2 of the Sherman Act. That's really not an issue in the association world. And then mergers between competitors are regulated by the Clayton Antitrust Act, but again, not really relevant to the association community. So let's drill down on these horizontal laws. This is an excerpt from the Sherman Antitrust Act. Every contract, combination, and form of trust or conspiracy in restraint of trade or commerce amongst the several states is declared to be illegal. Pretty simple statement. The Sherman Act doesn't really have much more than that, but it has been interpreted and construed by many, many courts, including the U.S. Supreme Court, many times over the last 100+ years. So we have a pretty good idea what it means because it's been interpreted in great detail. This contract, combination, or conspiracy really means agreements between competitors. But it doesn't have to be a formal agreement. There doesn't have to be a written agreement. It's often difficult for, say, an antitrust enforcement agency or a private plaintiff to prove that there's an agreement, but you don't have to show that there was any formal agreement, for instance, to fix prices, to agree on prices between competitors. It can be inferred from conduct. Actions of an association are often taken as evidence of an agreement among the members of the association to take action. That's because associations are by definition a combination of competitors, which is why there's always been a lot of antitrust scrutiny on trade and professional associations. One FTC official once said that associations are like a walking antitrust conspiracy. And it's not because associations are inherently doing anything wrong or illegal, but it's that because you already have this combination of competitors, that you've kind of already satisfied one of the steps in proving a horizontal antitrust violation. And so it makes the risk and potential liability risk, antitrust risk for associations much greater because you guys are by definition a combination of competitors. And even actions of an individual working for an association can be evidence of an agreement among the members of the association. So if someone, there's some background noise, if someone can mute their microphone, that would be great. Okay. Does the agreement harm? Yeah, whoever's typing, if you can mute your microphone, that would be great. So the question here that you have to ask in Section 1 Sherman Act analysis is, does the agreement harm competition? There are two ways to analyze these issues. One is two kind of categories of potential harm to competition. The first are what are called per se violations. These are agreements amongst competitors that are deemed to be anti-competitive on their face. And I'll talk more about examples of what are per se. These are the most serious types of violations and the ones that you want to do your best to do everything possible to try to avoid. And then there's a second category that might be anti-competitive, but they might not be. Basically, it's about the rule of reason test is like a balancing test. We balance the anti-competitive harm against the pro-competitive benefits of whatever the agreement is. And I'll get into that in more detail. So per se illegal agreements. These are agreements that always or almost always restrict competition and reduce output. And you'll hear that term sometimes in antitrust law analysis. The idea being that when competition is restricted, output gets reduced, meaning less competitors, less product or service on the market, with the idea being that means less choice for consumers, less ability to drive down prices for consumers, et cetera. The most serious per se violation of the antitrust laws is price fixing, without any question. It is the most serious, and this basically says two or more competitors cannot agree on the price to be charged for a product or service, even if that agreement is to keep it the same, even if the agreement is to reduce it, or if the agreement is to raise the prices. Any agreement between competitors about price or about price-related terms, like discounts, credit terms, and trade and allowances, all of these are strictly illegal under the antitrust laws. And so because this is such a serious per se violation, what trade and professional associations have always done over the years, at least those are trying to be antitrust compliant, sorry, is to make sure that your members and other competitors that are gathered at your meetings, on your online forums, and in any way, shape, or form, that they are not even discussing any price or price-related terms or exchanging price or price-related information. It all should be strictly off limits, even though you only have an antitrust violation if there is an agreement between competitors about price. But because it's so serious, you want to be sure there's not even a discussion of prices or price-related terms in any way, shape, or form flowing through the association or using the association's online forums, meetings, things like that. Another category of per se illegal agreements is market allocation. That's where two or more competitors agree to stay out of each other's markets so that they're not competing against each other. Bid rigging is another where the competitors agree not to bid against each other. And then this becomes more a nuanced antitrust analysis. Some group boycotts, for instance, if two or more competitors get together to enforce a price fixing agreement or harm a rival. So say that your board says, you have some new contractor that wants to join the association, but the contractor in this given city or state is known as a real price cutter, kind of undercutting everyone's prices. And you don't want to let this contractor into your club, so to speak, because you believe it'd be bad for business. And so you agree to keep this member out of membership. You boycott that membership, don't allow them to join or kick them out of membership, either way, to enforce a price fixing agreement. That would be a per se violation of the antitrust laws. Whereas generally speaking, if you're making a decision to deny someone membership or kick them out of membership, but it's not driven by something like price fixing agreement, generally that's going to be analyzed under the rule of reason. And in most cases, it's going to be absolutely fine and appropriate. Like, for instance, if someone doesn't meet your membership criteria, or if you have an enforceable code of ethics and they violated those, or you have some requirement about compliance with the law and they've been sanctioned or cited, or they're not properly licensed in the state or city or county. All of these things can be very legitimate bases for keeping a member out of membership or kicking them out. And then some exclusive dealing arrangements, but most are analyzed under the rule of reason. Per se violations like price fixing, market allocation, bid rigging can be criminal as well as civil, leading to jail time for those found guilty. So we have both criminal violations of the antitrust laws and civil. Most of the enforcement that we see in the antitrust area is civil, but there can be criminal violations that are enforced at the federal level by the U.S. Department of Justice and at the state level by the state attorneys general for per se violations. Here's some, there was an example of a criminal antitrust violation with a lysine price fixing cartel that created a subcommittee of an association as a pretext for meeting at association conferences and meetings to fix prices. Penalties can be severe, including jail time, fines up to $1 million for individuals and $100 million for organizations. If you suspect any criminal violation, it needs to be reported to a responsible officer of the association immediately. And let me stop for a second just to say that in terms of enforcement of the antitrust laws, you have federal enforcement that comes from two agencies, the U.S. Department of Justice, which enforces the Sherman Act and the Clayton Act and the Robinson-Patman Act and some other laws, both civil and criminal. And then you have federal enforcement from the Federal Trade Commission, which enforces the Federal Trade Commission Act, which has a lot of similarities to the various sections of the Sherman Act. At the state level, state antitrust laws, which every state has, including DC, are enforced by state attorneys general. And then there's a private right of action for violation of the federal antitrust laws, not the FTC Act, but the others. Most of the others have a private right of action. Same with state antitrust laws, meaning a private party, like for instance, a competitor who is harmed by the anti-competitive actions can bring a private lawsuit against those who are alleged to have violated the antitrust laws. And if they're successful under a lot of the statutes, they can, like the Sherman Act, they can recover triple the damages that they prove, plus attorney's fees. So it can be very significant and financially costly to violate the antitrust laws. So we see private lawsuits in this area, but then we see a lot of investigations and enforcement actions and lawsuits from federal and state regulators as well. Now, moving on from these per se violations to rule of reason violations. So for the less serious antitrust violations, they're analyzed under what's called the rule of reason. It's basically this balancing test, kind of a look at the restraint to see if it on balance either promotes competition or suppresses it, whichever more is the case. If it suppresses competition more than it promotes it, then it well may be illegal. You look at the restraint itself, but you also look at what's called the market power of the companies imposing the restraint. So basically, the bigger the market share, the greater the chance of a rule of reason violation. And then you look at potential efficiency justifications for the restraint. Why are you entering? Why are you restricting competition? There often are some very good reasons for doing so. For instance, if you have a certification program where you're setting standards, where you're trying to promote, and I'm going to talk about certification and standard setting in a bit. You're trying to promote compatibility amongst products, or you're trying to help ensure there's good actors in the field. Same thing with your membership requirements and whatnot. There often are very good reasons for having that restraint, which can make it very justifiable under the rule of reason analysis. Here's some kind of specific antitrust issues for associations where these things kind of come into play in the association world. First off, statistical reporting by the association. Unfortunately, I don't know the extent to which NECA or any of your associations engage in statistical reporting or information exchanges, but to the extent you do, and I'll talk more about each one of these in a minute, that can give rise to price fixing concerns. Certainly inappropriate communications between members at meetings, through online forums that are sponsored by the association. Any discussion of prices and price-related terms can give rise to potential price fixing violations. And then group boycotts, agreeing to, for instance, keep someone out of membership, keep someone out of your trade show, can be problematic under the antitrust laws. So let's drill down a bit into group boycotts. They can come up in a number of ways. I've talked a bit about self-regulation and codes of ethics. So that kind of the antitrust analysis when it comes to membership requirements, codes of ethics, certification, accreditation programs, it's all kind of the same. And I'll get into that analysis in a second. Just talk about standard setting, certification, and accreditation. And when I talk about membership requirements, not just membership qualifications and who can be a member, who doesn't qualify, who gets kicked out, but also access to association services and activities like access to your trade shows or your conference for non-members. Things like that raise antitrust concerns. This thing keeps bouncing back. It might be illegal per se, but generally they're going to be evaluated under the rule of reason. Where the association, so when can the association be liable versus the members being liable? So we've talked a lot, I've talked a lot about how these horizontal antitrust laws require an agreement between two or more members to do something that's anti-competitive. And certainly those individual companies and individuals who engage in anti-competitive, illegal agreements between themselves can be held liable both at the corporate and the personal level. But in addition, the association itself, and there's dozens of examples of cases over the years where the association itself was held liable for those antitrust violations, either because its staff were directly involved, or its senior leadership, its board, or its officers were directly involved, and the court or the enforcement agency found that the association should be held liable for that. There's also a very interesting example, a 1985 U.S. Supreme Court decision involving the American Society of Mechanical Engineers, where basically some members in certain leadership positions, it was like the chair of a standard setting committee, used their positions to harm a competitor in the market by interpreting certain safety standards in a way that required everyone in the industry to license certain patented technology from the company, and utilize their position as the chair or vice chair, I can't remember, of the standard setting committee without disclosing that information. Turned out to be very profitable to the company in terms of requiring everyone to license their patent, but very harmful to competition. A company that was injured by that, Hydro Level, filed suit, and the U.S. Supreme Court ultimately held the association liable. And the association took the position that, look, this individual who was doing all of this was doing it surreptitiously. He didn't have the authority to do this. He was lying to us, disclosing this. We should not be held liable. And the U.S. Supreme Court said, no, he was acting with the apparent authority of the association, and therefore the association should be held liable for his actions. And they basically said, look, this is a warning to associations in situations like this, that you need to regulate your members' conduct to be sure this kind of stuff doesn't happen. It's an important principle to keep in mind. Generally speaking, there should not be personal liability risk for, say, individual officers and directors and staff who exercise ordinary reasonable care in the performance and their duties, showing honesty and good faith. But there may be personal liability for those who participate in or knowingly approve of an antitrust violation. These are some other areas where the antitrust laws frequently come into play in the association world. I've talked about discussions at meetings, talked about membership requirements, services to members and non-members, talked about statistical reporting and information exchanges, standard setting certification, other kind of regulation of member conduct, online forums. I'll talk a little bit later about lobbying and antitrust compliance programs. So with regard to discussions at meetings, and all of this applies whether it's an in-person meeting, a virtual meeting, or an online forum, same issues apply. And that is, proof of an anti-competitive agreement can start with proof of parallel conduct. Like, you see, two or more competitors, all of a sudden not reducing their prices or raising their prices at the same time, kind of that parallel conduct by competitors. If that can be coupled with potentially illicit communications between competitors, that can be used as evidence of a price fixing violation and an antitrust violation. And because association meetings virtually always involve communications between rivals, between competitors, you have to be really careful to make sure those illicit communications do not happen. That means that discussions at meetings should be formalized and laid out ahead of time to the greatest extent possible, using agendas and sticking to them. So agendas and presentations prepared and distributed in advance of meetings is a best practice. It's generally a good practice at most meetings, especially things like board meetings, to read a brief, like one paragraph antitrust compliance statement, reminding everyone about what the antitrust laws prohibit, and making clear it's the strict policy of the association to comply with the antitrust laws. And if you guys ever need like a sample paragraph to read or whatnot, let me know. I'm happy to share that with you. You should try as much as possible to not depart from these agendas and materials during meetings, except as absolutely necessary. And then minutes should be kept in meetings that concisely reflect the discussions, especially where they might diverge from the pre-prepared materials. These are kind of some off-limit topics. Because these discussions could lead to illegal agreements, you generally want to try to eliminate and shut down any discussions of pricing, including discussions of methods, strategies, timing of pricing, discounts, advertising, or what constitutes a fair or reasonable price. You should not have your members discuss whether or not to do business with suppliers, customers, or competitors. You generally want to stay away from complaints about the business practices of other companies, both for antitrust reasons as well as claims like defamation and tortious interference. And then finally, confidential company plans regarding output decisions or decisions regarding future business plans, future offerings should not be discussed at association meetings. Now, moving on to statistical reporting and information exchanges. There can be both per se and rule of reason violations here. Because recall, per se violations include price fixing. They also include agreements to restrict output and market allocation. And there have been cases in the past where associations have utilized kind of statistical reporting and gathering of information in an industry as a way to kind of telegraph to other members, here's what we're planning on doing, therefore follow suit. We can all keep our prices high, for instance, or not offer discounts this next quarter, things like that. That's where some of the risk comes in. So when you, and it's very common, and it's an absolutely acceptable practice for associations to engage in some sort of statistical reporting and information exchanges, but you want to make sure that you are kind of following certain ground rules. And actually, I'm going to just, because I want to make sure we get through this. If you look at these 3 sub bullet points, these are really, there's this safe harbor that the U.S. Department of Justice and the FTC put out a number of years ago. And they said if you're going to do statistical reporting and information exchanges from competitors, including what associations do, many associations do this, if you follow these certain ground rules, it'll create a safe harbor. And generally, it's not going to turn into an antitrust violation. So these are the 3 basic things. And the idea behind it is that you can't derive any specific information from any individual member. So for instance, you want to aggregate information rather than have individual company data. You want to have it all aggregated, not listing the individual company data. The data collected, you can collect price information, but it needs to be historical price information that's at least 3 months old. It cannot be current pricing information, and it cannot be forward-looking. What do we plan on doing in our prices in the next 3 months? It's got to be at least 3-month-old data. And then you want to make sure there's enough companies participating, enough contractors in your case, so that it's difficult or impossible to determine whose information is whose. Where there are only a few companies in the industry, that may be difficult to do. And the DOJ FTC guidance says that you want to have a third party, like an industry association, manage the process. You don't want any individual members to be involved in the data collection process. And finally, you want to make sure that you avoid any unregulated discussion of the results amongst members. Now, moving on to membership requirements. These, from an antitrust perspective, are generally looked at as potential group boycotts. The antitrust analysis in this area is generally analyzed under the rule of reason. Again, unless it's like a group boycott to enforce a price fixing agreement, it's generally going to be a rule of reason analysis. Completely appropriate and proper, and many other good reasons for having, membership criteria for who can be a member, when someone can be kicked out. Have a lot of associations have enforceable codes of ethics that regulate conduct. There was some news in recent weeks involving the National Association of Realtors, which just expanded its code of ethics to regulate its members' conduct even outside of the real estate industry, basically to regulate their personal conduct. It's basically a new section of the code, that their code of ethics that they added, which prohibits any discriminatory or harassing kind of conduct or behavior, even in realtors' personal lives and personal social media and things like that. Very kind of controversial in that regard, because they are now able to and will likely be taking, it's all enforced by the state and local associations of realtors, but taking adverse action against their members that engage in that sort of conduct, even if it has nothing to do with their business. That's highly unusual. And it's going to be interesting to see if that becomes a bit of a trend. But my point here, go back. my point here is that it's not at all unusual, and it's appropriate to have membership criteria, enforceable codes of ethics, things like that. But you want to be sure that there's some plausible justification for why you're having certain restrictions. And again, I've written whole articles and given presentations on this topic alone. You want to be sure that whatever criteria you have for your membership, who can be a member, code of ethics, things like that, you want to be sure it's clear, it's objective. So you don't want criteria that are going to be subjective in how they get analyzed. You want to make it as clear and objective as possible. You need to be, and you want to make sure that there's some legitimate rationale, for why you're having the justification. And then the second part of it is on the enforcement side. You want to be sure you enforce those rules with great consistency and objectivity. And you want to be sure that you give appropriate due process, especially if you're taking something away from someone, you're kicking them out of membership, you're revoking their certification, things like that. You want to give them every modicum of due process, a chance to defend themselves, have an attorney present, perhaps an appeal right, things like that. You want to do that to the greatest extent possible. It'll help protect your association. There's a number of factors. Like you look at the second bullet point, are the rules objective and consistently applied? If the rules are subjective, is there a legitimate reason for the rule based on the pro-competitive needs of the association? And again, do you give due process for those who are expelled or denied membership? Give them a notice and opportunity to respond, have an appeal process, and make sure that the decision makers, whoever's making these decisions, don't have any conflicts of interest, that they're independent, disinterested decision makers. I'm going to skip over this. So I get this question a lot. It's an issue that has come up over the years with associations, and that is when you offer services to members, are you allowed to, for instance, require someone to be a member in order to take advantage of those services? Or if you're going to offer them to non-members, can you charge a higher price? And the general rule here in this area is that unless, whether it's a product or service, whether it's access to a trade show, whether it's a product you're selling, a statistical report, whatever the case is, unless that product or service is essential in order for the member or the individual company or individual to effectively compete in the market. So unless the product or service is essential in order for effective competition in the market, which unfortunately is rarely the case for any association product or service. So unless that's the case, you do not have to offer it to non-members. You can offer it to members only. You can require someone to join as a member before you offer that product or service. If it was the rare situation where it is essential in order to effectively compete in the market, let's say, your association administered a certification program that was, say, sanctioned by a particular state law, and you cannot get a license in that state without getting certified by your association. And obviously you can't practice in that state without having a license. That would be something that is essential for to effectively compete in the market, and where you would not want to have to require someone to become a member before they could get certified. But that's rarely the case, and I think especially so in your world. And as a result, you can also charge a higher price for non-members, with the understanding that they're not helping to subsidize the development or whatever of that product or service, so you can charge them a higher price. Some general guidelines in this area: take a look at the services that the association provides to see if they are essential for effective competition in the industry. Generally, it's not going to be the case. And I've really talked about all of this already. So moving on. With respect to trade shows, again, it's the same basic analysis. While your trade shows might be very valuable, and hopefully they are, for folks to participate in, as long as it's not essential to effectively compete in the market, you could limit it to members only. But in terms of what are your rules for even being able to exhibit at the trade show, you always want to, and in fact, just yesterday I was working on a set of exhibitor rules, because a client of ours, an association, has been having some problems with some exhibitors in the past, kind of engaging in some bad conduct basically at the trade show. So we were working on kind of their terms and conditions. When you sign up registered to be an exhibitor, these are the rules that you have to follow. You want to make sure those rules are objective and reasonable, and that they're objectively and consistently applied. And if you have, limited space, like most associations do for a trade show, I mean, it's a problem that unfortunately no one's really dealing with right now because we're not having in-person trade shows. But when we get back to in-person trade shows, if you have limited space, you can have a first come, first serve arrangement and things like that. And you can deny someone membership if they're not complying with your rules or they violated your rules in the past. Just don't exclude a company for anti-competitive reasons. Do not apply your rules in a discriminatory, inconsistent, or subjective manner. Don't base decisions on whether the company engages in competitive pricing. Don't condition decisions on whether a company agrees to appear at a competing trade show, and don't use subjective criteria for participation or allocation of resources. Standard setting. I mean, there's a lot of standard setting that is applicable to electrical contractors, and it's just ironic that like some of the examples I have here have to do with your whole industry that your associations represent. But I'm not sure that you guys, especially your state and local groups, engage in any kind of standard setting. So I really don't want to spend much time on this. But just to let you know that these slides are here if you want to learn more about standard setting, or if you're ever concerned about how standards set by other organizations like the National Fire Protection Association apply to your members. I lost it again. And this slide just distinguishes health and safety standards. This is a pretty well-known U.S. Supreme Court decision involving an NFPA standard on conduits. A good real-life example, it's probably 25, 30 years old now, that case, but a good real-life example of how these antitrust laws do apply in your industry as well. So that was talking about health and safety standards. There's also, as you well know in your industry, your members certainly know compatibility standards, about how certain products work together or compatible. Again, it's a very kind of strong reason why a lot of associations engage in standard setting to ensure compatibility amongst products. It's a very pro-competitive reason for doing so, even if it has some anti-competitive consequences. It's a good example of that rule of reason balancing test, where generally, standards that help promote compatibility, we see it a lot in the, certainly in your world, in the electrical area, see it a lot in the high-tech world generally. The more compatibility there is, the more, generally speaking, that it's going to be beneficial to consumers. That's why those are generally pro-competitive. And this is talking about monopolization. There's a whole kind of series of case law and enforcement actions involving companies that have a monopoly, and they're using that monopoly. If you have a monopoly in a certain area, there are certain rules regarding providing reasonable access and reasonable licensing terms to your patents to allow others to be able to take advantage of that. But I'm not going to get into that here. Certification and accreditation programs. Basically, the analysis is exactly what I went through with respect to membership criteria and codes of ethics. Again, I don't think you guys engage in certification and accreditation programs, so I'm not going to focus on this, but just know that the analysis is the same. And you see a common theme here. Were your criteria objective and rational, some legitimate purpose, and were they applied on a consistent and objective basis, and were you following your own rules? These are things that come up all the time. I deal with these issues quite a bit, and I can't stress the importance enough when you're making membership decisions and things like that, whether to admit someone, whether to kick someone out, whether to suspend someone, whether to sanction them under a code of ethics. It's really, really important that the criteria themselves be clear, objective. You should be able to look at it and say, yes, a member or would-be member meets the standard, or they don't, and then you want to apply them consistently and objectively. Most of the, and provide due process and follow your own rules. Most of the problems, antitrust problems that arise in this area, I say antitrust, we also deal with defamation and tortious interference claims as well. But most of the problems that arise in this area arise because one of these things here on the screen were not being done. This is, again, same basic analysis, talking about codes of ethics, codes of conduct regarding members. I'm not going to rehash the analysis, but I will say there's an increasing trend in the association world to have, codes of ethics are generally, we see it especially in professional associations, They regulate essentially, usually they regulate member conduct in the industry, how you're behaving as a corporate citizen within the industry. There's two different types of codes of ethics. There's enforceable and aspirational. It's exactly what the name suggests. Enforceable codes of ethics are enforceable. They carry with it by far the highest degree of legal risk. But they, if you want to have an effect on regulating bad conduct in an industry or profession, having an enforceable code of ethics like the National Association of Realtors has is an effective way to do so. An aspirational code is just that we encourage our members to aspire to achieve, these standards, but if they don't, we don't take any adverse action against them. That's carries with it very little risk from a legal perspective, but also doesn't have a lot of teeth to it as well. But in addition to those kind of codes of ethics that are sometimes a condition of membership, sometimes they're kind of separate and apart from the bylaws, they usually are separate and apart, but can have an effect, like if you get, some sort of a violation of code of ethics that might require you to be suspended or kicked out of membership. But separate and apart from that, we've seen a trend in recent years, particularly in the, when the Me Too movement really came on strong about 3 years ago or so, whatever it's been. We've seen increasingly associations adopting codes of conduct for their meetings and conferences. Again, prior to the pandemic, lots and lots of association meetings and conferences. Not much going on these days, but every hope that they will come back in full force at some point next year. And there's just been heightened sensitivity to essentially, bad conduct, member conduct, non-members at association gatherings. I deal with a lot of these on the back end after the fact, helping to, associations navigate enforcement and whatnot. I'd say most of the bad conduct involves harassment. Most of it involves alcohol at after hours, the bar at conference hotels and other things like that. That's where we see most of the allegations. But as a result of this, it's kind of becoming, I think, a best practice for associations to adopt a code of conduct for all participants at gatherings, whether you're a member or non-member, doesn't matter. And then having the ability to do some enforcement after the fact if there are violations. We even have started to see, and I actually have some samples of virtual codes of conduct. Obviously, the risk of potential problems and violations are much less, but we have seen some bad conduct, at association virtual conferences, but especially on like online forums and whatnot. The association sponsor, harassing or discriminatory type comments and whatnot. And it's always been a best practice for years since kind of the advent of online association forums to have some sort of rules of the road. Before you can sign up to participate in this forum, you agree to abide by all these rules, terms and conditions. Some of it relates to, you can't discuss prices and other antitrust sensitive issues. Many other things as well. I can't make defamatory comments, can't infringe anyone's copyrights or trademarks, can't invade anyone's privacy, can't engage in harassment, things like that. That's always been a best practice. If you have any online forum, you should have a set of rules and you should require your participants before they join to click and accept that they agree to them. And then you should probably send them out at least once a year, to the whole forum, to all registrants on the forum to remind them of those rules. But you might want to consider adopting a code of conduct for your events as well. Yeah, I'm not going to get into this anymore, but these are some of the types of restrictions that we've seen in codes of ethics. And there was the most recent U.S. Supreme Court decision from a few years ago involved the California Dental Association, where they had restrictions on advertising by dentists in California. Ultimately, the U.S. Supreme Court found that those restrictions in the Code of Ethics were illegal under the antitrust laws because they were basically, forget some of the details, it's been a while since I read the case, but it basically said they were not allowing dentists to engage in fulsome competition through advertising because of these restrictions that were imposed by the codes of ethics, and they found that they were illegal under the Section 5 of the FTC Act. Again, this is revisiting this issue of online forums for member communication, especially during the pandemic. This is how so many members are communicating with each other since we're not having a lot of in-person meetings. You want to, like I said, have rules regarding off-limit discussions and other acceptable and non-acceptable behavior and discussions on the forum. Make sure that you get everyone to click and accept that they agree. And then the second sub bullet point, you don't have to do this, and some associations take a position that they're not going to monitor their online forums at all. But I think my sense is it's become a best practice in recent years to have some sort of general monitoring of online forums by staff. Not screen, I mean, some associations will actually screen every message before it can be posted. I have a few clients that do that. That's not the norm. You definitely don't have to do that. But you should generally be monitoring, these forums to the greatest extent possible. And certainly, if someone comes to you and says, hey, this member posted this really problematic comment or whatnot, you need to take prompt corrective action. That's critical for keeping the association out of legal trouble, right? So the individual who makes a defamatory comment or starts to ask everyone what prices they're going to be charging for the services next month or next year, that person might well get themselves into trouble under antitrust laws or other laws. But you as the association, it's basically a new or should have known standard. Did you know of the violation, or should you have known? And did you not take immediate corrective action when it came to your attention? So the way that you, and this applies in so many areas, the way that you protect your association from potential liability is you have good rules, good policies. I'll talk a little bit later about antitrust compliance policies. You have those rules of the road for your online forums. So, you write good rules, you get everyone to click and accept that they agree to them, you send them out once a year, you include a copy of your antitrust compliancy, in all board books and things like that. And then if you become aware of a problematic, action, comment, whatever, by a member or otherwise, then you take prompt corrective action. For an online forum, that means take it down right away, followed up by potential discipline against the person. Is it the first offense, second offense, third offense, all sorts of potential discipline that could happen, from kicking them off the forum or suspending them for a while to suspending their membership or sanctioning them or kicking them out of membership. There's lots of different options depending on the severity of the violation, whether it's a repeat offender or whatnot. But those are the kinds of things that you want to do to protect your association itself from being liable for those things. We're getting close to the end here. So lobbying is good, bona fide lobbying is exempt from the antitrust laws because of the First Amendment. But basically, petitioning the government, federal, state, local, cannot form the basis of an antitrust violation based on the, basically it's rooted in the First Amendment. So if you are a bona fide lobbying effort, even if it was an anti-competitive effort, say you're lobbying a state legislature or a state agency, to keep a competitor out of the market because you believe they engage in dangerous business practices. Certainly very anti-competitive. If two or more competitors got together and, through your association or otherwise, engage in some sort of group boycott, that would be highly illegal. But if you are simply lobbying a government agency or legislature to do that, that's protected under what's called the Noor-Pennington doctrine. It's those words come from two different U.S. Supreme Court decisions that form the basis for that essentially exemption from the antitrust laws. But there are some cases that say if the lobbying is a sham and has an anti-competitive impact itself, not the effect of a government policy, but kind of the sham lobbying effort, then that can form the basis of an antitrust violation. Okay, finally, antitrust compliance programs. So antitrust compliance policies have really become mandatory for associations. Every association should have an antitrust compliance policy. I know that NECA has one. Yes, I know that NECA has one. Many of you may have one that's based on NECA's. If any of you need a sample antitrust or model antitrust compliance policy for associations, I'm happy to provide that to you. But you should all have a board adopted antitrust compliance policy that says this is our policy to comply with the antitrust laws. These are the things that we will not do, discussions that are off limits, practices like group boycotts that are off limits, and here's the things we do to ensure compliance with the antitrust laws. It's really important to have one. Like I said earlier, distribute it on a regular basis, have it posted on your website, include it in board books, things like that. And then here's some other kind of responsible antitrust practices. The board adopts and affirms the antitrust compliance policy, included in board books and maybe similar materials. Read a short, like I said, one paragraph antitrust compliance statement at the beginning of board meetings, and as well as maybe committee meetings that have antitrust sensitive agenda items. This is not what has to happen on a regular basis, but whenever you have a board meeting or committee meeting that has antitrust sensitive agenda items, you really should have legal counsel present. It used to be the norm back in the day, even still a little bit when I started practicing 25 years ago, for legal counsel to be present at all, say, board meetings of trade and professional associations. That is not the norm anymore. That's not kind of the best practice anymore. But the idea behind it was to regulate discussions, to be sure that no problematic discussions occurred at the meeting and to shut it down if they did. To me, it's never been an effective use of resources, legal resources, and the association's money. But I do attend a number of board meetings each year, and sometimes even committee meetings, where there are some very antitrust sensitive items on the agenda. And I have one actually later today. It's a client in the pharmaceutical industry. The pharmaceutical industry has always been especially sensitive to antitrust laws, and their pharma companies, are generally very lawyered up, and they insist for this particular trade association of companies in the pharma industry that for certain things they want legal counsel present at every single meeting. That's not the norm, but keep in mind, if you have antitrust sensitive agenda items, consider having legal counsel present, and certainly have legal counsel review in advance of antitrust sensitive documents, programs, and activities. And when I say legal counsel, I mean legal counsel who's experienced with antitrust laws, because your general counsel may or may not have that experience. And that is the end of our prepared presentation. Open it up for any questions that you guys may have.
I have a question.
Sure.
You mentioned a paragraph about antitrust that could be used at meetings and that you would be willing to share that.
Yeah.
Is that something that you could send to Jeff Fagan maybe, and I can share it with the group?
Absolutely. I will send that to Jeff. That's a general paragraph that you should, you're obviously free to use, but just keep in mind, if you have, any antitrust sensitive items on the agenda or whatnot, it might require, a more specific statement that's, tied directly to that particular discussion item.
Got it. Thank you.
Hey, Jeff, I've got a question.
Yeah.
We do a number of different things in the education area. And one of the things that we get asked for all the time is, do we have a pattern form for this type of contract, or do we have a pattern paragraph for this type of contractual provision? And, certainly when members are asking for that, they're looking for, some help in negotiating with the your contractor or an owner. Do you have any concerns about NECA sort of stamping contractual documents and then disseminating them out there to the membership, from an antitrust perspective?
Yeah, it's a great question, Jeff, and it's something that's come up over the years. There's been some cases involving kind of form contracts and forms generally in certain industries and professions. The answer is it depends on what's in there. So for instance, if it's just a basic, customer contract, right? That you're going to use with your customers. And if it has, for instance, the provisions regarding, statement of here's the parties, here's the date of service, here's language about, choice of law, choice of venue, if there's a dispute, arbitration, those sorts of things. Generally, those don't give rise to any competitive concerns. So even if, 2 or more members agree to all use that same form, that's not going to inhibit competition between them. But if you had provisions in there regarding pricing or whatnot, now obviously you're not going to include any specifics about what people should charge or anything like that. But if there was some of the cases involved like a pricing structure or pricing system, which itself could be anti-competitive if a bunch of competitors agree to that, because it might inhibit other forms of pricing that might provide more options and benefits to consumers. That's where it could be potentially problematic. Now, so you basically got to go through each provision. And so, for instance, if you were putting together a form contract, you know, you on the price or fee section, whatever, just say pricing or fees and then leave it blank, you know, let everyone fill in their own, that sort of a thing. And then the rest of the stuff that's pretty innocuous should not be a problem. And then you always want to accompany it right at the top, you know, say like, this is a sample contract, you know, but we're not requiring or even encouraging you to use it. You know, you feel free to use your own, change it as much as you want. There's good language out there that I've seen other associations use.
Okay, thanks. Helpful.
Sure. Other questions? I know I covered a lot, and feel free to ask about, you know, if you have any questions on the nonprofit kind of corporate and tax stuff as well.